bond valuations. And each of the parts, one of the question requires us to find bond price, but in different scenarios, right? In different scenarios, because question 1A is different from question 1B and C. But even though they are all requiring us to find the bond price and all that, so before you can, start with the solution, you need to go through and understand the questions and the dynamics of the questions and what the question is requesting for you and the information that is given in the question. So you need to first analyze the question, understand the question. That's the first thing you need to know. Then after that, you pick out the informations from the questions. Then the third one is you write the formulas, the variable formulas that you need. And then the fourth one is, you conclude the answer. So we are starting with the first one, the part A. So 1A is what we in your PLC. Talk. And we are given so let's list the available information from the question 1A. So from the question, what are the things that we can see from the part 1A? Part 1A, we can see face value. And see face value. You can also see 6%. And this 6% is the required return or the maturity rate. So that 6% is yield to maturity. And also you can see 10%. This is the coupon rate. And what again? So 10 years, which is the yield to maturity. So the total payment is 10 million. So let's list them. So our face value is what? Our face value equals 10, sorry, 100, 0. And then the total face value is total face value. It's also 10 million. And also we have coupon rate, which is equal to 10%. 10%. And yield to maturity. Also equals to 6%. So either yield to maturity or market yield. Was 6%. So these are the available information from the question, right? And we are to find the price of the bond in the AI setup. If the bond is paid once in a year, so annual payment. So with the if bond is paid annually, so price if bond is paid annually, so what then is the formula to find bond price? So what then is the formula to find what bond price? Is anyone having a suggestion about the formula? Bond price. Hello. Hello.
Hi.
Yeah, please, the formula for finding the bond price. Why I can find this? So it is the present value of the coupon plus the present value of the par. And this coupon is paid annually, like It's a fixed payment that is paid annually. So to find the present value of the coupon, we are going to use the annuity formula to discount that coupon to today. And then the present value of the par is also a single amount that we pay at the maturity year. So at the end of the 10 years, you pay that face value of the par at the end of the 10 years. But the coupon is paid annually for 10 years. So to find the present value of the par, we are going to discount this to find the present value of the par, we are going to use a single cash flow formula to discount it back to present. So basically, if you want to find a bond price, you discount all the cash flows back to what? Today. Yeah. So I'm looking for my equation. I can't find it. I don't know. Okay. So we are starting with the present value of the using the annuity formula. So this is the annuity formula you are going to use. And the present value of the single cash flow is what? Future value over our discounting what? Factor 1 plus our R raised to the power n. So first of all, the C over there is the coupon payment. So we need to find the coupon payment before we insert it into the formula. Because right now we don't know the coupon payment that we are going to pay annually. But to find the coupon payment, this is the formula to us use to find the coupon payment. It is the coupon rate. The coupon rate times your face value or par. So if annually, that means the rates you are going to use the same rate. You are not going to do any adjustment to the rate because it is annually. Always the coupon rate is given in annual terms. So 10% time the face value will give you the coupon payment. 10% times coupon payment face value is 100. So when you find 10% of the 100, what will be the value for the coupon payment?
10.
All right. So where my C is, I will write 10. And the rate is the what? Yield to maturity or the market yield. That's the I over there. So 6%. Zero point 0.06. Zero point 0.06. The face value is 100. 0.06. And then the n is also raised to the power 10 years. So please, someone should punch this formula and give me the final answer. I don't know why. Or I should use this one. 200 brackets 1 plus 6 power 10. Negative or 10. Yeah, so someone should punch this, but you are going to punch it separately. You use the annuity. You punch the annuity separately and punch the single amount so separately. Is that there?
The annuity is 9.433.
9.4434.
434.
Like this.
Yes, please.
Then the single amount.
The single amount is 55.84.
Have you discounted?
Yes, I entered it as seen on the screen.
No, give me this in the whole amount.
What?
The whole value.
I should add it.
Like give me the exact value that you had.
55.834 83947769.
So end it here.
Okay.
The annuity said I had 9 points.
9.43. It was 9.4339. So I rounded it to get 9.434.
Come.
So if I
So
add up,
wait, because of like I cannot type in this thing. I cannot raise it to the power 10. So in your formula, when you are doing the brackets 1 plus 0.06, raise it to what? Power 10. Raise it to
the,
power 10.
the whole bracket.
No, only the down one.
I should raise the down one to power 10.
Yeah, over 10. The 1 plus the rate is raised to power 10.
Okay, let me. Yes. Is it raised to the power 10 or minus 10?
So when it is down, it is power 10. If it is top, it is minus 10.
All right. That will give me 73.600.
73 points
601.
601.
Yes, please.
Okay. Let me see if I can write it. Yeah. Two point zero six. So now you add all and get the final answer for the bond price. So when you add all, what are you getting?
We get 129 point
129.440.
440.
So you do it 129.44. So this will be the final answer for the bond price if coupon is what paid annually. So the II price if coupon is paid semi-annually. So you are going to use the same formula, but you have to adjust the coupon payments. Now coupon is what paid annually. So the only thing you are going to find the coupon payments for annual semi-annual terms. So that one, the formula will be the rate. Now the rate, we are going to adjust the rates. So 10% divided by 2. So the 10%, 0.2, we are going to raise it to power 2. We have to divide the 10%. The 10% is what? For the whole year. So half of 10% will be what? 10% divided by 2. Then you multiply it by the face value. The face value is what? 100. So we are going to get 5.
Yeah.
Right here. So we copy. I'm copying the whole terms and I'll just adjust the coupon payments. So the same thing. Yes, give me the values and then so here to the this thing. We are going to adjust the years. So the years will be multiplied by what? 2. Here to the years, we are going to what? Multiply by what? 2. Right. Annually. So we multiply that one by 2. For the annual what? Terms, and this one to multiply by 2. So that's the few adjustments that you are going to do for the, and then the rates. Yeah, sorry. The this thing to the periods. So let me do the workings here and make it. So 6%. 6%. You adjust the 6% times 2. You are going to get 3%. Get 3%. And the years too. The years, that is the yield to maturity. This is the yield to maturity. Yield to maturity. And the maturity listen. maturity date. Maturity date. The 10 years. We got 10 years times 2. It's going to give us 20. Zero point 0.06 divided by 2. So let's equate them into the formula. So 3 and here 20. Make the workings simple. 20. Then here to change it to 3. Here to negative 20. So and here 2, 3. So now give me the present value for the coupon payments and the present value for the face value separately. Hello.
Yes, I'm with you. Um, the annuity, the first one is 74.39.
70.39.
The second one is 55.37.
37. So when you add all, we are getting
129.76.
129.76. 129.76. So okay. Now the next question is, given the current price of the bond calculated in question was question 1I. So they are referring to this one, the first one, the price that you calculated, right? Cost is the total value of renewal debt. Determine whether the bond is well priced or not. So I total debt of reunion. So we need to find the total value. So the total value or the total debt is the number of bonds times the price per share times price per share, price per bond. We know the price already, right? You have calculated in what? 1 AI. But the number of bond we don't know. So we need to calculate that one, number of bond. Find the number of bond. To find the number of bond, it is the total value of the bond, which is the total face value divided by the bond per each watch, per the what, per the total value, the 10 million over what each bond face value, give us the total number of what bonds. So 10 million 10 million 10 million fraction 10 million divided by 10. So we are going to get 100,000. So the total value of bonds will be 100,000. So now, therefore, the total debts will be what? Or the total value will be 10,000 times the 100,000 times the price. The price in A is 129.44. So when you multiply 129.4 944. Yeah. So this will be the total value of what? Union based on the current price. And the II is in 2 or 2. So let's do it Ivan. Let's do it Ivan. So we see is the bond well price. So we need to do some checks to answer this question. You are going to compare some things to know whether the bond price is well priced or not. Right. So bond pricing, we can have bond price, we can have maturity, and we can have premium price and the normal price and discount price. When the bond price is equal to the coupon rate, so we are going to check the coupon rates and the maturity dates based on the price. So in our question, the question gives us what 10% coupon rate and 6% yield towards maturity or required returns. So based on the coupon rate, which is the 10%, that 10% is what greater than the required returns, which is the 6%. So since the bond coupons rate 10% is greater than the market yield 6%, the bond is what? The bond price is above the par. Now check the par. Par is what? 100. Par is what? 100 in the question. But the price is what? 129.44. So based on that, that's why the bond price is greater than the par or the face value. So anytime there is inverse relationship between the coupon rates and the bond price. There is an inverse relationship between the coupon rates, the 10%, and the bond price itself. So when you check and you see that the coupon rate is greater than the maturity or the yield to maturity rate, definitely the bond price will be greater than the face value or the par. And when the coupon rate is now lower than the maturity rate, then definitely the bond price will be lower than the par. So that is the basis. There is there is an inverse relationship between the coupon rate and the bond price, but a direct relationship there's an inverse relationship between coupon rates. No, that one is what? Direct relationship. And the bond price. And there is an indirect relationship between market yield or yield to maturity and the bond price. So here you see we saw that the coupon rate, it was greater than the yield to maturity, and that made the bond price being greater than the face value. But there is an inverse relationship between yield to maturity and the bond. So you say, to answer that, you say since the coupon rate 10% is greater, since the coupon rate 10% is greater than the market yield, the bond price, the bonds price is above the par. The bond price, which is 129.44, is above the par. Market rate is what? 6%. So since the coupon rate 10% is greater than the market yield 6%, the bonds price 129.44 is above the what per 100 full stop. So this premium, so that means that the bond price is traded at what? A premium, not discounts, or not the normal what rate. So this premium reflects the higher of the higher than market coupon rates. So the price is well, the bond price, the bond is well priced. Full stop. So that will end the one, part A. Now let's go to the B. Taylor Incorporation is expected to have a year-end dividend. So that one too, we will start by listing the various information from the data. So we're giving that we are giving D1 expected or dividends. Expected dividends is what? $4. So D1 expected dividends. And please, so far is everything okay? Do you have any questions to ask? So expected dividends is 4. Then we have earnings per share. Earnings per share. So 6. We also have required returns. So required returns R equals 12%. And required return on equity equals to 12%. 12%. This one is 14. So this is the information given to us in the question. Yeah, there are 4. 1, 2, 3, 4. And the question is asking us to find, if you are an analyst who believes in efficient markets, what would be your forecast of GIN? So that means you are going to find GIN and the price. So This one you are finding the price and the what and the goods weight. The goods weight is the chain over there. Okay, so I forecast rates, goods rates. To find your goods rates, this is the formula. So Jane plus retention rate, tension rate times required rates of return required on returns on equity. But from the question, we are not giving what retention rates. We're not giving retention rates. So we need to find retention rates. Need to find retention rates. So I can find the what? The goods. That will help us find the price. Okay. So to find our retention rates, so that the retention rates and clawback are like they are opposite to each other. So retention rates is the fraction of what our earnings, the fraction that we retain it to operate the business, and clawback or retain clawback and retention rates are the same. Whether you see if you see clawback, it's the same as your retention rates. And we also have something like payout ratio. Payout ratio. Payout ratio is the fraction of your earnings that you pay towards the shareholders. The fraction of your earnings the business pay to their what shareholders. And then the retention rate or the clawback ratio is the fraction of the what earnings that they retain in the business to keep the operation going. So retention rates plus payout ratio. So that will give you what one. Now this one is also minus clawback ratio. Somewhere you can see clawback. So if you want to find each of them, just make the other one the subjects. And there's another formula. So the first this is the first method to find any of them. This is the first method. So this one is what? Method what? Method what? One. We also have, we can use the ratio, and we can use the returns, the earnings, and the what? The yield towards the returns and the dividends to also establish a relationship to find the what the them. So that one, to find your with earnings, find your retention ratio, retention ratio is your earnings per share minus dividends divided by earnings per share. And if you also want to find the payout ratio to it's also computed like a fraction of the earnings. So that one is this. Dividends. Payout is what the fraction of your earnings that you pay towards shareholders. So dividends is profit that we pay towards shareholders. So the dividends divided by or dividend divided by earnings per share. Yeah. So either we use this approach or use the second approach to find them. So if you realize the first approach was not given to us because we don't have payout ratio in the approach to make retention ratio the subject of the formula to find the retention ratio, right? But we can still use the first one. But if you use the first approach to find retention rates, you need to first find what your payout ratio. You need to first find your payout ratio before you can use the first approach, right? But if you don't want to go these two processes and finding payout ratio before you can find the retention ratio, you can just go straightforward and find the retention ratio using this method. Method, right? So from here you can find our retention ratio. So our retention ratio, we are going to use this approach, straightforward. So the dividends given to earnings per share is what 6. Dividends is what 4. Oh, dividends is 4. And this one too is 6. So when you type it in your calculator, what are you getting? Hello.
Hi.
What are you getting for the retention ratio?
That's 0.33.
Okay. So do this for me to the payout ratio so that I'll show you how the two approach works.
0.67.
0.67. Now let's find retention ratio from the first method.
However, the payout ratio I'm getting is no, the retention ratio I'm getting
You are getting
zero.
for the
For the
second method,
retention, no, the first one,
this one,
the
y0.
I don't know.
How did you how did you solve it?
I inputted it into the calculator. Six minus four. Sorry, I
Yeah.
was thinking six minus two. No, okay. This is four then. I think okay.
So
Okay.
the
Zero
payout
point three.
ratio is 0.67. So this one will give us retention ratio will be what? 0.33, right?
Yeah,
So you
zero
see,
point three.
how the two methods they work. So either you use the first method or the second method. But if you want to use the first method, the one I've colored yellow, you need to first of all find your payout ratio using the 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 second method to find the payout ratio before you can now um, fix it into the first method to find your retention ratio. But if you don't want to first of all find your payout ratio, then you can go straight to the point and use the second method to find your retention ratio. Then you just continue with your work. Um, yeah. So now we are fine with retention ratio. We can find what's our forecast rate. So our rates so that it was this. Retention ratio is 0.33 and required returns on equity is 12%, 0.12. should give us. That won't give us what?
0.03 0.04.
0.03.
No, 0.04 if you run it.
So you give me the whole number so that we run it, or maybe someone will know. 364.
96.
Okay. Zero point 0.0396. Then you run it towards 0.4. Okay. So the
Hello.
II. Yeah.
Hello.
Hi.
I think it would rather be 0.04.
Oh, okay. Okay. Thank you. So the next thing we are going to do is we'll find the price of the bond. So price of the bond. We have D1 is 4. Price equals to the price of bond P zero equals we are going to use the goods approach. The D1 divided by the rates minus the gain we have calculated. Ooh. So D1 is what? 4. The question D1 is what?
Okay, please, which question number are you solving?
1 B. 1B. So the D1 is 4. R is 0.14%, and this one is 0.04, and the D1 is 4. So when you punch this, you get hello. So what are you getting for the price? I had 40.
Yeah, that's
Am
it.
I correct? Am I correct?
Yes, please.
So that will be the end for 1B. So C. C is a mark till mining. Finish. So metal mining companies or reserves are being depleted, so its sales are falling. Also, its pit is getting deeper each year, so its costs are rising. As a result, the company's earnings and dividends are declining at the constant rate of 5% per year. If D1 is $5, and returns is also 15%. What is the value of metal mining stock? So, given to first state the information that we have. We have what D1 equals D1 is 5. First we have required returns equals 15%, and we have goods just also equals to what 5%. So we need to find the price. So stock price is the price. We are using this formula. D1 is 5. R is 15%, 0.15. Gene is what 5, 0.05. But here, you have to take note of the things. You said that this thing is declining. The rate. So this rate is what? There's a negative attached to it. Declining at the constant rate of 5%. So we need to what? Apply that. So it will be negative. To be negative, so that it will affect the formula. This one is also 5. So when you do this, you are going to get something like this. Plus Yeah. So we get
25.
75 or
25.
25. Okay. So that's for the part C of question 1. We move on to question 2. Question 2. Microtech corporation is expanding rapidly and its currently needs to retain all of its earnings, hence it does not pay any dividends. However, investors expect Microtech to begin paying dividends with the first dividends of $1 coming 3 years from today. Okay. The dividends should grow rapidly at a rate of 50% per year during years 4 and 5. After year 5, the company should grow at a constant rate of 8% per year. If the required return on the stock is 15%, what is the value of the stock today? So this one, we are going to use the scenario in the slides activity, the one we did in class. That's what we are going to use. We have variable word growth rate. So question 2. A. Macrotech. So from the question we are given what? So the dividend started in year 3. Year 2 and year 1 and 2 dividend is 0. So year 3 dividend is what? Year 3 dividend is $1. Year 4 dividend is what? For year so year 1 it will go by the rate. So it will be 1, then you raise your 1 multiplied by this 1 point. The rate during the fast growing stage is what? 50%. So the rate time is to be what? 5 to give us what? So we have 4 dividends is 1.45. So I'm using this formula. find D1, discuss your current dividends divided by times 1 plus the gain, then you close the bracket. So when you do that, you get the D3 and 4. And D5 is D5 will be what? 1.5 times 1.5. So you get, hello,
You get 2.25.
okay. Now after this, the fifth year, say that the company should grow at a constant rate of 8% per year, perpetuity, forever. So we need to find the perpetuity, which is at the year 6 going. Year 6 going. Right. So we are going to grow this using the perpetuity formula to grow this. The constant rate. You are going to use the constant rate, the perpetuity rate to grow this to year 6. Right. Yeah. So you are going to find the D6 to be what? 2.25. 2.25 multiplied by the constant. That one is 8, 0.08. That one will give us
0.18.
let me state the formula. The formula is D5
Okay.
times Gen 2. We are going to use Gen 2 to do this one. Let me modify it to Gen 1. .25 times 0. So that times yeah. So that one will be 1.08. So the final answer will be
2.43.
2.43.
Please, as the class ended.
Hello. Hello. Please let's continue tomorrow. It's almost 5.